All right, everyone, we are at the top of the hour, so I will get us started. Hi, everyone, and welcome to today's Advisor Today webinar. Today, we're joined by Ryan Mattern and Brandon Perry, who will discuss your client's life insurance needs now that sometimes might require some out-of-the-box solutions. Just a few housekeeping items, just so everyone knows. Today's webinar is being recorded and will be sent out to everyone in the coming days. In that email, we'll also include a survey and would really appreciate your feedback as to what kind of topics you'd like to see in the future so we can put this into our plans. If you do have a question throughout today's presentation, feel free to ask it using the Q&A feature, and Ryan and Brandon will do their best to answer the questions periodically. Before we dive in, I did want to say that today's webinar is brought to you by Modern Life. Ryan and Brandon will tell us a bit more about Modern Life during their session, but if you want to learn more about them, their website is www.modernlife.com. Ryan and Brandon will also provide their contact info in case you want to get with them directly after the webinar. Remember that Advisor Today offers NAIFA members a print magazine, offers subscribers great content in newsletter form, webinar series like today, and we also have a new weekly podcast focused on what innovative agents and advisors are doing to grow their practice. So if you want to get more content like today's and a whole lot more, visit at.naifa.org. So without further ado, I will turn the virtual floor over to Ryan and Brandon of Modern Life so they can tell you a bit more about who they are and what they do. Take it away.
Awesome, Kevin. Thank you so much. And everybody, we appreciate you taking time out of your day to come and attend the webinar. We really appreciate it. All right, you can go to the next slide, please. Okay, so today, as Kevin said, my name is Brandon Perry. I'm one of the brokerage managers here at Modern Life, a team of several brokerage managers, all with industry-leading experience. We're all very, very high knowledge individuals, and Ryan will be leading the bulk of the presentation today. He comes with over 20 years of advanced planning experience, so he's worked on some of the biggest, most complex unicorn cases in the industry. And Modern Life, a quick overview of who we are before we get started on the presentation. Modern Life is an insurtech. And what that means for you is we're a technology company that is an insurance brokerage. So what that means is we have a full team of software engineers and developers building a platform that's going to make selling insurance easier than ever before, while also delivering a platform that's gorgeous and something that you're really proud to show all of your clients. And we also have industry-leading back office support. So you have myself and the team of brokerage managers there helping you with your white glove support. You've got proactive case management, advanced sales, underwriting support, everything you need to make sure that all of your cases are being handled in a very, very professional manner. You have access to all major carriers, including but not limited to the ones listed on the screen. And we also have a broad suite of products. So we have solutions for just about any need that you're going to come into for life annuities, LTC, and DI. And again, our website is modernlife.com. So I encourage you all to take some time and go check out that website after the presentation. With no further ado, I'll pass it over to Ryan and he'll go through the agenda and get us started.
Thanks, Brandon. And again, thank you all for your time here this afternoon. I guess morning for the West Coast folks as well. So yeah, what we're going to cover today is just a few of the more commonly missed sales opportunities with life insurance. You know, it's in our human nature a lot of times to have a certain process, a certain routine of how we go about our everyday lives, right? And sometimes that could spill over into when we're talking with our clients. And if we have our heads down and forward, and sometimes that might prohibit us from seeing an opportunity that might be right in front of us or something that might be very apparent. But unless we're, you know, asking the right questions or having the right conversations, it might be an opportunity that we walk right past. So some of the material that is in here today is not going to be overly complex from a conceptual standpoint, but rather just the focus is, you know, the kinds of discussions to keep in mind, the kind of things to keep in mind as you're out there talking with your, you know, your business owner clients, your wealthy estate planning clients, in some cases both. So as far as the agenda today, we're going to be focusing on four main topics on both the business side and the personal side of things. So first is just using permanent insurance in key person arrangements as sort of a retention tool. Sounds pretty simple and obvious, right? But we'll get into a few different ideas to keep in mind there. Second is using life insurance as sort of a Roth IRA lookalike or alternative type plan. Again, pretty simple, but we'll get into some detail. Then using life insurance as an asset class, reducing some of the client's potential portfolio volatility and, you know, avoid putting all your eggs in one basket, so to speak. And then lastly, we'll touch on the idea of using corporate loan regime split dollar specifically for C Corp owners and some of the advantages there. And as mentioned, we can certainly take a pause after each one of these and answer any questions, check the Q&A panel as we go along. So again, feel free to raise the virtual hand and ask away as those questions do arise. So again, the first one here is just going to be centered around the idea of employee retention, specifically in regards to typical key person arrangements. So as we saw with the Great Resignation with COVID during that time, and some folks leaving their jobs, some going down the street to different jobs to greener pastures and all of that, it's becoming ever more important just in general for business owners to really keep those key employees tied to the business. So how can we do that with life insurance? And that's what we're going to get into here today. So again, first, most of us are familiar with the typical key person arrangement, right? Its main purpose is to not only find a suitable replacement for that key employee and train them, it also needs to keep the business afloat, keep the creditor satisfied, and assure that there won't be any issues in that regard. And also just keeping their customers satisfied, right? And some of those cases where that notion of goodwill comes into play. So as far as ownership structure, we obviously know that simply the business being both the owner and beneficiary of that policy. And since the business does own it, we also have to make sure that 101J is complied with, of course. And I thought it might be beneficial here, just for the folks that aren't aware of 101J and what that entails. Failure to comply could potentially cost hundreds of thousands of dollars in taxes down the road for the business owner. So with 101J, we just want to make sure that the notice and consent form is signed, the employee signs off, consent to be insured. I know ABC Business owns a policy on me. They keep that in the business file. And then whoever does the taxes, their corporate accountant has to file IRS form 8925 each year with the corporate return. So the 8925 is not entirely critical. If they miss that, it's just a failure to file penalty, which might be $50 to $100. Don't hold me to that, but that's kind of the ballpark. But the big one there is that notice and consent form. So if they ever get audited, if the employee passes away and they can't produce that notice and consent form, the business does become income taxable to the business. So again, just want to make sure that we're on the same page with 101J. If any of you have any questions about that, we're happy to discuss in more detail offline. Maybe that's missed opportunity number 5 in addition to the 4 that we have here today. But back to key person and the type of product that we can use. With these types of arrangements, our minds tend to gravitate towards a term policy, right? It's usually the easiest and cheapest to implement and put into place and provide that peace of mind for that duration. But I think less than 2% of term policies ever actually pay out a claim, maybe even lower than that. So with key person coverage, if most times the business is just throwing that money away with a term product, unless of course the employee does pass away during that term period. So only in a small percent of cases is cost recovery ever actually achieved. And on the same token, a term policy really doesn't provide anything in the way of keeping that employee incentivized to stay with the business. So there's no real way to utilize the term policy in that regard. So that brings us to the solution here, and it's just the simple split dollar plan. So let's bet on the more likely event of the key employee being alive and actually retiring versus passing away prematurely. So if we think about it, if the individual is so important to the business that they would put key person coverage on them in the first place and go through the whole process, it stands to reason that the employee is important enough to also keep tied to the company as a golden handcuff. So we could do that with a simple endorsement split dollar plan. And I know some of you are familiar with the concept, but there's a nice little twist that we'll go over here. So just like traditional key person, business is going to own the policy initially, we'll pay the premium, we'll retain all rights to the cash value in the policy, and then we'll just endorse a portion of that death benefit over to the key employee during those working years. We'd like to think of it in terms of just the employee essentially renting that death benefit from the business. So what is the cost of that rent? Well, that's just the ongoing economic benefit charge each year. And that's just a simple term charge based on those table 2001 rates that the feds put out. But some carriers do have their own term rates that are lower that we can sometimes utilize, but 2001 is going to be the default there. So those rates do go up with age, but it's pennies on the dollar, especially at the younger ages. And it's not the economic benefit charge that the employee actually pays, but just rather the tax on that already low charge. So in any given year, if the employee does pass prematurely, his or her heirs receive their portion of that death benefit tax-free because that tax was being paid, that rental charge basically. So that goes on every year that the endorsement is actually in place. So where does the retention aspect come into play? Well, when the split dollar arrangement is initially put into place, the business and the key employee will agree upon some service requirement duration, whether it be 10 years, 20 years, age 65, whatever. So if they stay with them for that agreed upon time frame, the business is then under obligation to transfer that policy over to the key employee. Now, we have to be careful because unless we structure it properly, there is the potential to bring this all underneath Section 409 Cap A compliance, which comes along with traditional deferred compensation plans. And that was brought about to really fight those abuses of these plans. Think Enron. We have them to thank for all of that mess. But it's really just a rigorous reporting requirement that not only has a cost for compliance, but the failure to comply carries a very, very hefty price tag with taxes and penalties. So I bring that up because there is a way that we can get out from underneath 409A altogether when that policy is ultimately transferred. So long as the entire policy is given to the key employee in one shot, and this is key, in one shot within 2.5 months of the end of the calendar year in which that requirement is met, we can avoid 409A altogether. It's completely out of the picture from day one. It's actually called the short-term deferral exception. It's oddly enough, it's found within Section 409A itself. So if the employee retires today, the business has until March 15th of 2023, for example, 2.5 months into the next calendar year, to give them that policy. Now, at the time of the transfer, the employee does have to pay the taxes on the fair market value of the policy at that time, which in most cases, we max fund the policy, we just take a withdrawal at that time since they now own it. So we're not asking the individual to come up with anything else out of their own pocket, which is especially important as they're getting to that age to nearing retirement. Consequently, the business gets a corresponding tax deduction on the back end based on that same fair market value. So if you think about it, it provides either cost recovery during those working years if the employee passes away, but also provides a nice little tax deduction on the back end in the likely event of the key employee retiring. And lastly, it does provide even a tighter retention if the employee becomes sick or has a health concern in any way. So they know that if they go elsewhere and try to get a policy on the open market, they may be either highly rated or flat out declined. So this could entice them to stay even more, knowing that they'll eventually get a policy with a much more favorable rating. And just an extreme example, let's say the employee does come down with a terminal illness and may be unable to work altogether. The business does still have the option of transferring that policy over to the employee, even if they don't satisfy that service requirement, as a sign of good faith and kind of put that individual's mind at ease at a time when they might be facing some hardship. So I know some people, myself included, always like to have a visual of how the numbers actually work. But here's just a simple case study. So have a key employee, male, age 40, good health, who's vital to the business. They want to keep on board and prevent them from leaving. So they're going to implement a simple split dollar plan here, and with an initial death benefit of about $471,000. And we're max funding it so that we have a 20-pay premium of $25,000 a year. So the intention is to have a 20-year service requirement. We're going to roll this out in year 21, transferred over to the over to the employee at that time. Now, if we back up and look at year one, and this is just the employee side of things. So if we look at year one, total endorsed amount over to him is going to be about $446,000. So the business has to retain their portion in any given year, and which by definition is at least the greater of the premiums paid into the policy or the cash value. The rest can be endorsed over. And that's not to say we can't do a 50-50 split of the death benefit to keep more on the business side for key person or things of that nature, or a 75-25 split, whatever, just so long as the business retains their minimum portion at that time. So at his age, at that amount of endorsement, reportable economic benefit there in year one is just $491. But remember, he's just paying the tax on that amount. So at his tax bracket, $123 in year one at that time. So God forbid he passes away, his heirs get $446,000, only costs him $123 in that first year. You see those charges do go up with age, as I mentioned, and then by year 20, we're at about $2,700, still only costs him $682 for $450,000 of tax-free benefit for his heirs. So then after those 20 years, that service requirement's met, policy is going to be transferred over to the employee at that time. And it has about $751,000 of cash value. And we're going to assume that to be the fair market value that he pays the tax on, which comes out to about $187,000. And a quick side note, that Actual fair market value could be different than the actual account value. We're just using this for illustrative purposes. As long as there's no secondary guarantees built into the policy, anything of that nature, it should be close to the account value. But bottom line, it's something that the carrier would ultimately have to provide at the time of transfer. So we have the tax of $187,000, but since we are max funding it, just take a withdrawal from the policy at that time to pay the tax. Policy is then free and clear, no encumbrances. He can tap into it tax-free for income, leave it alone for death benefit purposes if it's more of an estate planning play, whatever. It's completely up to him at that point. And then consequently, the business also gets a tax deduction based on that same $751,000 at that time. Now, if he were to leave the business prematurely, business can keep the policy. Doesn't have to get rid of it. It's under no obligation at all. So can surrender the policy for cash, keep it until that death benefit eventually pays out down the road, stop paying premium, let it run its course, whatever it wants. It can do whatever it wants with that policy at that time. Now, we can do this with any carrier, especially if there are underwriting concerns, anything of that nature, but we do have some that will administer the plan for you, and one in particular that will even do it for free. So all that annual economic benefit reporting, periodic reviews of the policy to make sure it's on track, it's performing up to plan, all that stuff. So you don't have to go it alone. We have the resources to help you out with it. And also the snapshot that you do see here is a page right from our own carrier software that we create, or our own software that we created. So we can customize this for you, any cases that you might come across. It's carrier neutral. So we like to get the client comfortable with the concept first and, and then find the carrier to fit. So, as Brandon mentioned earlier, I do want to reiterate that, we are tech forward, but we also have the capability to not only support these cases and talk about them, but also model the more complex ones for you as well, as those opportunities do arise.
Okay, and Ryan, that was great info. Really quick, so dual-headed question here. So number one is, could an owner be considered a key employee? And then as a follow-up, can you also discriminate between employees, or do you have to give all employees the same benefit?
Yep, I'll take the first one, the second one first. Yeah, so it is a non-qualified plan, so it's completely discriminatory. You can pick and choose what employees you want to put it on. You can have one employee using an index product. You can have one employee using a variable product. Certainly, you can pick and choose. You don't have to include everybody in the plan like you do with your qualified plans and such, and those pension plans. So, good question. And if for the owner, if we're looking at an owner in this case, it really does have to be a C Corp. And I'll touch on this later in the presentation. It really has to be a C Corp. So if you have any other business entities like your S Corps, your partnerships, some of your LLCs, the flow through nature of it, it doesn't provide any tax leverage for the business owner. In some cases, it provides double taxation. Since you're using after-tax dollars, and you have to pay tax on the economic benefit, it sometimes creates a second layer of taxation. So you can do it on a business owner, but it really does have to be a C Corp. But it really, for split dollar situations, we'll get into it, really might be the better thing to do for the C Corp owners might be a loan regime, as I touched on earlier, and we'll get into some of that later, but good question.
Fantastic.
And next, as I mentioned earlier, is just using life insurance really as an alternative to a Roth IRA, using it as sort of a lookalike plan. So when we think about retirement planning and sources of income, we traditionally have our, Social Security. Who knows how much longer that's going to be around. We have our personal bank accounts, our brokerage accounts, and then, our qualified plans like your employer sponsored plans and such. And, we know IRAs can be beneficial for those folks that may not have an employer plan like a 401k. But if we talk about IRAs in general, what makes a Roth different from a traditional IRA? Well, we know the main difference really lies in the timing of the actual tax advantages, right? So with a traditional IRA, you deduct contributions now, pay taxes on the back end when you take that income out, as opposed to a Roth, which you pay taxes on the contributions now, but receive that tax-free income on the back end. I'm sure we all know this, and of course, the both vehicles do grow on a tax-deferred basis. So Roths operate much like a normal investment account versus an IRA, but with some tax benefits. Now, if we're comparing life insurance to a Roth, we obviously see a few similarities here. Both are going to be funded using after-tax dollars. They're going to Both grow on a tax-deferred basis. There's going to be tax-free income on the back end, assuming that we structure the life policy properly, of course. Withdrawals to basis, switch to loans, all of that good stuff. Also making sure that the policy is not a modified endowment contract, obviously. But then we start to get into some of the differences between the two. So there's no RMD requirement with a Roth like you have with a traditional IRA, but there is still that pre-59.5, 10% penalty for early withdrawals with a Roth. Something you aren't limited to with life insurance. Again, making sure the policy is not a mech, or in some cases that penalty could apply. But the biggest difference here is really the contribution limits. So with a Roth, we're limited to just $6,000 as far as what you're allowed to contribute to the plan on an annual basis. And then that bumps up to $7,000 for people over age 50. And also, if you're a single individual making over, I believe, $144,000, or a married couple making over $214,000, you cannot contribute to a Roth at all. It's simply not an option. So you don't have those limitations with life insurance. The only limit really is whatever death benefit that funding yields has to be financially justified. So if I'm worth $5 million, I can't go out and buy a $10 million policy and max fund it just because I can. But otherwise, the client really can put as much money in as they want into the life insurance with this in mind. So again, there's no contribution limits at all. Then also on the life side, we can add some downside protection as well in some cases, whether it's whole life product, an indexed UL with a guaranteed floor, things of that nature. So we can perhaps give the client a little more peace of mind in that regard. Now, I'm certainly not saying or recommending that clients that are currently contributing to a Roth switch gears and change vehicles in any way. This is more for those folks who are either over that salary threshold, are already maxed out on their contributions, and just want to add to their overall plan. So life insurance can really add some value in that regard. So with that, I'm going to switch gears here and just hand it over to Brandon for a sec, just to go through a live case and comparison here. So Brandon, take it away.
Thank you. Thank you, Ryan. I appreciate it. So when we were going over this topic, we actually had a live case recently that fit really nicely into this presentation topic. So we had a 40-year-old female, preferred health. She has 2 children. Unfortunately, she is separated. $125,000 salary, and based on a couple of life situations and events that have happened to her, which are not unique to her in any way, shape, or form, she's trying to catch up on retirement savings. So she has $12,000 a year to invest, and debt-free other than the mortgage, which does put her in a really good spot from that perspective. And ultimately, she came to the advisor and said, I really like the idea of a Roth IRA, but I need to invest more. Like, what do you have that's similar? The advisor came to us and we talked about life insurance. Ultimately, she already had some coverage in force. So she had a shortfall of $150,000 of death benefit. She had $6,000 to put into life insurance for years 1 through 10, is expecting her income to continue to rise. So she wanted to throw in $7,000 a year from policy year 11 through policy year 20. And then she wanted to take max income years 21 through 35. And she'd seen her parents both end up in nursing homes. So she certainly was concerned about long-term care and wanted to make sure that if she could mitigate that risk as well, she certainly wanted to do that. Okay, and so ultimately, when it was all said and done, based on our illustrative assumptions, which we can talk about offline, anybody can reach out to us afterwards. We can go through the actual illustrations. We looked at a combination of both a life insurance policy and a Roth IRA. As you can see, in the years, we're putting in $6,000 for 1 through 10, and then we increased to $7,000. We gave you the snapshot at policy year 15 and policy year 20. We're looking at very similar cash accumulation between the two. Obviously, the life insurance does come with the tax-free death benefit. So if the unfortunate event were to happen of her passing, before she gets to her distribution phase, there's a nice benefit there for her beneficiaries. In both scenarios, we were able to pull the exact same amount of money, so just under $24,000 a year. And we pulled that out for policy years 21 through 35. And then still, if she outlives that at policy year 40, when she is 80, we're still looking at about $86,000 of tax-free death benefit. And all the while, we do have a long-term care coverage in force. And Ryan, you can go to the next slide. Awesome, thank you. Okay, and so ultimately the client outcome was, yes, she decided to split the funds, go with both the life insurance policy and the Roth IRA. It increased her diversification and her tax advantaged income in retirement, because obviously, as we know, They both offer tax-free deferral with tax advantage distributions. And then we got additional advantages, like, for example, we had the long-term care in effect that whole time, which, is certainly a nice benefit and a little bit of ease for her and her family that, if the event pops up, she's well taken care of. Okay, and Ryan, you can go to the next slide. Okay, and we've got a couple of questions before we get to the next topic. So the first one that I'll touch on is, besides the life insurance benefit, how can you handle the objection of just doing a Roth conversion to give the high earner a tax advantage bucket? Thinking of the business owner who puts away into a SEP IRA and can convert to a Roth.
I'm sorry, I missed the first part of that.
Oh, sure. So it's besides the life insurance benefit, how can you handle the objection of just doing a Roth conversion to give the high earner a tax advantage bucket?
Yeah, aside from the life insurance death benefit, on the back end, you are, it is the tax-free income on the back end. Again, the concern there was that long-term care portion. That should be a part of every conversation that you're having with the clients, because if LTC coverage is ever needed and the proper coverage is not in place, those LTC costs could drain those retirement accounts, those brokerage accounts, the bank accounts pretty darn quick if you don't have that LTC rider on there. So that's another intrinsic value that life insurance can provide. Aside from the Roth, aside from the tax advantage nature and the death benefit. So again, those are certainly things that should be kept in mind and having those discussions as well.
Fantastic. Thank you so much. Okay, and one more question before we go on. Regarding the no contribution limit, is one restricted to the scheduled premium payments established at the incorporation of the policy, or can one make additional payments into the policy at any point during the life of the policy?
Yeah, so if it's max funded at inception, we do have to, if they want to put more money into it, it really has to be a recalculation each year to see how much more they could. But if it's overfunded or minimally funded, it doesn't have to be. These products are flexible. So if year one we want to put in 12 grand, year two if there's a little bit more room and they want to put in 20 grand, that's certainly fine. We just have to make sure that we're funding it up to the MEC limit and not going $1 over, or else it becomes we lose the tax advantage nature of the life insurance. So good question.
Absolutely. And Ken, the last part of your question is, would doing so make the policy a MEC? Ultimately, the answer is it depends. We would have to do a recalculation. So in most cases, you can do a recalculation. It'll just depend.
Yep. And that's something we can help with and the carriers can provide, but on an annual basis, we can find out what those actual max limits are, certainly.
Absolutely.
I think that was it. So next up is the idea of using really life insurance as an asset class. And it's really directed at your clients that are somewhat uneasy about the market. I think that applies now more than ever, right? So they may want to consider the idea of life insurance as a means to stabilize their portfolio, transfer some of that wealth regardless of actual market performance. And really they just be directing a small percentage of their overall portfolio towards the use of life insurance premium. And it just allows them to pass on those assets more generally in a tax-free manner. So in the early years, that life insurance is going to offer significantly more than some other hypothetical investment. I think it's a pretty safe assumption. But as time goes on, that leverage does become less and less. So, will there be a point where it's more beneficial to leave those assets invested? Certainly. And that's where we can help and do the analysis and see where that crossover point may be, ideally and hopefully after life expectancy. So we should never really consider life insurance as a true investment, right? I know that's even a bad word for some people, but if we look at the three different types of classes, we have cash, fixed income, equities. Life insurance sometimes checks two of those boxes: cash in the way of the death benefit, and then fixed income in the way of the cash value in the LIRP, if that's desired. But in most cases, however, we're really just focused more on the death benefit aspect for estate planning purposes. So in many cases, life insurance can be a nice non-market correlated asset too for folks to add to their overall plan. But if we go back to the housing crisis in 2008, COVID in 2020, and for example, many folks that were not diversified saw their portfolio take a real hit, obviously. So In the financial world, we know that timing's everything, but sometimes we can't just control that timing. But life insurance can really bring about some real overall stability to the client's overall legacy goal. So provides immediate leverage from day one. We'll go over an example here in a second. Also provides death benefit guarantees. So it's never going to decline, generally speaking, aside from taking any cash out or anything like that. Again, we can make it a non-market correlated asset. And I like to think of it, I'm kind of saying this tongue in cheek, but I like to think of life insurance as really almost like a mortality bond, a bond that's really going to mature at the exact moment that it's really needed most. And then lastly, if structured properly, the life insurance is going to be held outside of the client's taxable estate, things we all know. Now we can really use any product here, but many times a simple guaranteed UL could be the logical choice. But having an IUL or BUL with secondary guarantees built in that builds up some cash value, that also has its merits. So even though we might not pull cash from it, still provides that option of a potential 1035 down the road or things of that nature. And further, it just seems that traditional GULs are just becoming less and less abundant. So we're really just seeing a natural uptick in those other products. And also, if the client's concerned about losing that portion of the portfolio that's earmarked for premium, we can perhaps look at a product with, say, a return of premium death benefit option, maybe use an option 2 increasing death benefit option. So premium is going to be a little bit higher, of course, but this might help to mitigate some of that concern if they see that some of that returned on the back end by way of that increased death benefit. Just in general, though, a lot of times using an option 2 or 3, and these are things that we look at on a case-by-case basis. Sometimes that does increase the overall IRRs down the road, so we can help to juice it up a little bit there. So just some additional things to keep in mind there as well. So we have another example here, female, age 50, in preferred health, and she has a total net worth portfolio of about $20 million, and she is fairly liquid. And her advisor approached her about adding $5 million to in life insurance to her overall plan, and we're assuming that she has no insurance in force currently at all. So the premium for $5 million of coverage at her age is just over $40,000 per year on an all-pay basis. So if we look at a present value calculation of those premium payments out to life expectancy, she would have to earmark just under $700,000, about $697 to fund that premium stream. So looking at the pie chart there, you'd have to allocate that little green slice there just for the life insurance, but we can increase her overall portfolio from $20 million up to about 24.3 for the benefit of her kids. So she'd have to utilize about 3.5% of her total overall portfolio, but we're increasing the ultimate benefit by over 21% for her heirs tax-free. And this can all be modeled for you as well. This is something we can create on a case-by-case basis as we come across them. And just to give some hypothetical context here from a case study standpoint, let's say that the client owns a share of stock owns stock that's worth $10 a share. In order to match the leverage obtained with life insurance, in this case, that same share would have to grow to over sevenfold, up to about $71 per share. That's pretty powerful stuff. And that assumes that the stock never loses value going forward, which is a pretty big assumption. So the life insurance, obviously, in pretty much all cases, is going to be in a trust, outside of the reach of Uncle Sam, and outside of the client's taxable estate. Any questions there? No? Look like. And then last, but certainly not least, is really the idea of using loan regime split dollar for business owners, particularly C corporation owners. So we love C corps because really they're the only entity, as I mentioned before, that's separate from the business owner for tax purposes. So all of your non-qualified plan opportunities are on the table, whether it's traditional deferred comp, whether it's executive bonus, or in our case here, split dollar. So, and again, any other flow through entity like your S corps, your partnerships, you can still implement a non-qualified plan for the owner, but it really doesn't provide any tax leverage at all. And again, as I mentioned, in some cases, it provides double taxation. So you're one and the same as the business for tax purposes, so it doesn't make any sense really in that regard. So one of the obvious advantages of a C Corp is that limited liability aspect, right? So the business and the business owner are going to be kept separated in that regard. The one drawback, though, is that potential for double taxation. So not only is the business taxed at the corporate level when those profits are earned, but the business owner is also taxed at the personal level when those profits are taken from the business as taxable compensation. So if we back up to the Tax Cuts and Jobs Act of 2018, we saw the corporate tax bracket get slashed from 35% down to 21%. So this 14 basis point drop was essentially a 40% reduction in taxes. Not 40 basis points, but a 40% reduction going from the 35 down to 21. Or conversely, really a 40% tax savings for the business. So how can the business owner avoid that second layer of taxation when taking those increased profits from the business? Well, we can simply put a loan regime split dollar plan in place for the business owner. So it's going to be owned personally. Then the business owner will just loan himself or herself that money from the business to pay the premiums on that life insurance policy. And then the owner is really just responsible for that loan interest based on the published AFRs at that time, really just the AFR interest back to the business each year. And that could be either paid in full back to the business, or you can have the business forgive that interest, and then the owner just pays the tax on that forgiveness. So anytime you forgive anybody debt, that's income to them in that year of forgiveness. So if we forgive the interest, we just have to pay the tax on that forgiveness. In many cases, though, the business owner may prefer just to pay the loan interest back to themselves, so as to maybe disinherit Uncle Sam. I'm sure some of you have clients out there that just don't like paying taxes in any form. So that might be the course of action. So at some point, that loan does have to be repaid. But just like the loan interest, that can either be repaid in full or can be forgiven, and then the owner just pays the tax again on that forgiveness. In most cases, we are going to have a max funded or overfunded policy. So we can simply take a withdrawal from the policy at that time to fund the rollout when that time actually comes. And here's just one more example of how really a comparison might look between taking those profits as taxable compensation and investing in some side fund versus utilizing a split dollar arrangement and max funding that life insurance policy. So right here, we have a male age 40 in preferred health and is in a 25% tax bracket. Owns a fairly successful business, and we're going to assume, just to make the math simple, they're enjoying a profit of $100,000 a year for the next 10 years. So given that 14% drop in the tax bracket, the business owner now has an extra $14,000 per year to work with. So on the left side, we're going to assume that he takes that $14,000 as compensation. And after 25% for taxes, he's left with $10,500. So he's investing that over a 10-year period into some hypothetical account yielding 4.31. And the reason we're using that amount is we're comparing that to an IUL at 5.74. So that's just really the net after tax effect. So at age 66, has about $251,000 that side fund to work with, and yields an income of about $23,000 from ages 66 to 80. And it's exhausted, no residual death benefit on the back end, obviously. So let's compare that to a split dollar arrangement where he takes that $14,000 as loans over that 10-year period. So he's able to utilize that entire $14,000 since we don't have to net out the taxes. He does have to pay loan interest back to the business each year, but as the business owner, this is essentially going from his personal pocket over to his business pocket. So it's really the same pair of pants, just going from one pocket to the other. So in this particular example, we are also assuming that the loan is going to be forgiven at age 65, and we just take a withdrawal from the policy to pay the tax on that forgiveness. When all is said and done, still is going to leave $369,000 of cash value at age 66, yields about $40,000 of tax-free income from ages 66 to 80. And at the back end, at age 90, still have about $350,000 left over in residual death benefit when he does eventually pass away, for the benefit of his kids down the road. So pretty powerful stuff. And also, I know I mentioned, at the beginning of the hour about using endorsement split dollar as a means of employee retention. This is also a good retention tool as well. So if you do have key employees, this is not just for business owners, also for key employees as well. So it still provides a degree of retention. So even though it's owned personally, there is that outstanding loan that the employee does have to pay back to the business in any given year. So if they leave prematurely, whether the loan is going to be forgiven or whether it's going to be forced to be paid back in full, the employee might not leave, especially in those early years, and especially with surrender charges and whatnot. So if they leave prematurely, they might have to come up out of their own pocket with that additional money to pay back that loan or to pay the tax on that forgiveness. So even loan regime split dollar is a great retention tool for those key employees as well. And while we're on the subject, I know there's probably some college football fans out there, and particularly some Michigan fans maybe. And I'm sure many of you are familiar with the Jim Harbaugh arrangement. And Michigan and Harbaugh actually have a loan regime split dollar plan in place. I think they're giving them $2 million a year for 7 years, and I think they're coming up just on that 7-year period. So there's about $14 million of outstanding loan that Harbaugh is going to be due back to Michigan at some point. Whether they forgive that or whether it's going to be repaid in full, if he leaves now in the in the 7th year, especially if they're still in that surrender period, that's going to be something that the policy is just not going to support. So he's going to have to come up with that additional money out of his own pocket. Now, it might be pocket change for Harbaugh, who knows? But that still provides a degree of retention, keeping him tied to the university, knowing that if he leaves early, there's going to be that big loan hanging over his head. I didn't work on the Harbaugh case. That's more of the most famous one, the one that they really marketed and put out in the first place. However, I did work on 3 Division I coaches in the past. 2 were Division I football coaches, and 1 was a female basketball coach for the women's team. So again, if any of you out there have any networking, if you have an in with the university, athletic directors, coaches, just keep that in mind. We're more than happy to discuss those cases as well as you do come across them. So, folks, before we end, I know Brandon has some closing comments here, but if you do have any questions after we're done here, more than happy to discuss, get on the phone with you, but certainly appreciate your time. And if there are any questions, we'll take them now. But Brandon, I'll let you kind of close us out here.
Okay, Ryan, thank you so much. And on the topic of split dollar, as a wise man once told me, there's not a better dollar than a split dollar. And again, thank you everybody for your time. In conclusion, again, Modern Life, we're here to provide leading edge technology, advanced brokerage expertise, and comprehensive insurance products to help you on anything from your smallest to your largest opportunities. We're very, very fortunate to work with some fantastic advisors such as Scott DeSantis and Jared Levy, who were kind enough to put in their thoughts on Modern Life and how their experience has been. And please come to our website, check us out, and we'll be more than happy to help you out however we can. And with that, we will open up Q&A. So I've got a couple here geared up, and then anybody that has any questions that haven't already been answered, please put them in now. So Ryan, just going back to the last part on split dollar, there was a question on where the 5.74% illustrative assumption came from.
Yeah, so we were using a certain carrier. Some of you might know the default rate that carrier comes from, but no, that was just the AG 49 max default rate in the illustration that we were using. Just comparing that to an after-tax effect on the side fund. No assumption really. That was just what the carrier's illustrative rate was at that time.
Absolutely. Thank you, Ryan. Okay, and we've got one last question here. This is going back to the first topic. So it's just to clarify, a business entity retains ownership on the policy for the first 20 years, but the beneficiary designations are chosen by the key employee, or are the designations chosen by the key employee?
Yep. So the primary beneficiary is going to be the business. They have to recoup their costs first. Again, the greater of the premiums paid or the cash value. And then the rest that's endorsed over, that is the key employee. It's a beneficiary of their choosing. So they're going to be that secondary beneficiary for the remaining portion of that death benefit. Again, receive tax-free because we are paying the tax on an economic benefit charge each year. So, yep, and that could be anybody. It could be kids. It could be a spouse. It can be anybody they want really as that beneficiary for their choosing. So, good question.
Very good. And the last one here isn't a question so much as a comment from our friend Jose, who said, just as a side note, in addition to all mentioned, it offers security to dignity. And I couldn't agree more. So Jose, thank you so much for putting that in the chat. And again, as next steps, anybody that has any questions, you can email us at brokerage@modernlife.com. You can go to our website, modernlife.com, and go on and register and get set up with us and check out our platform and how we're able to help you out. And with that, I'll thank you all for your time, and everybody have a great rest of your day.
Thanks, everybody.
Thanks so much, Brandon and Ryan. As a reminder, the recording will be sent out to everyone in the next day or two, so be on the lookout for that in your inboxes. If there are no further questions, then yeah, thank you everyone for your time, and that concludes today's webinar.